All right, good morning, everyone, or afternoon, depending on which part of the country you're in. My name is Chris Paulson, and I am a regional director here at Golden Care, if you don't know me already. And I would like to welcome you all to our presentation today on Thrivent Financial's long-term care insurance product. I have the pleasure of introducing our featured guest today, Melanie Hertz. But before I do, if you are not contracted with us or you want to learn more about Golden Care and the products and services that we offer, please visit us at goldencareagent.com or call our marketing team at 1-800-842-7799. We offer competitive commissions, a diverse portfolio of senior life and health products and carriers, including Thrivent Long-Term Care and other products. But most of all, we provide world-class support and service to our amazing agents every day. Reach out to us to find out more. Today, I have the distinct honor to introduce Melanie Hertz. She is a nationally recognized authority on long-term care issues and provides the finest long-term care solutions to producers across the United States. Mrs. Hertz is known for her high-energy seminars encompassing all the topics most important to companies, agents, and consumers today. She was raised on her family's cattle ranch in the heart of North Dakota. She has a passion for making a difference in the lives of others and does so by donating a lot of her time to various charitable causes. Now, before I say too much, I would like to introduce to you all Melanie Hertz.
Hey, thanks a lot. No pressure to keep this thing high energy, making you feel like this was well worth your time. So over the next 3 hours, we're going to feel really solid about Thrivent's long-term care solutions. I'm just kidding, just kidding. Okay, so today we're going to do a deep dive on our brand new solution, Care Forward, just recently been launched. It is a long-term care solution on a life insurance chassis, and we're definitely going to take a close look under the hood at that. And hypothetically today, as we go through this, I'll even do just a little bit of hands-on in the software so you can kind of see those moving parts a little bit. Before I jump into today's presentation, I want you to know that this presentation is intended only to educate you. It's broad in scope for training purposes and does not consider your client's individual personal financial situation. Your client's personal financial situation is unique, and the information and advice may not be suitable for all situations. So as far as Thrivent goes, who we are as a company, you've maybe seen that our recent upgrade with Comdex to a rating of 100, definitely kind of an outlier in this long-term care arena, having a Comdex of 100, A++ rating. We talk about our strengths, but I want to highlight it. It really is the foundation of who we are. Here at Thrivent, we are honored to help folks achieve financial clarity. And as you can see, when you talk about the different buckets of who Thrivent is as a company, we do the life insurance side is certainly a big portion of who we are. We'll talk about how long we've been in the business, but you can see what we've had for benefits paid out in life and health over the years. 17.2 million hours of volunteer time giving back to our communities, and have built 159 homes through the partnership of Habitat for Humanity. All of those are funded by Thrivent fraternal dollars. We'll talk about those in just 1 second here. Thrivent is really set up to be a diversified financial services organization, providing financial advice, investments, insurance, banking, and our generosity programs, all in line to help people make the most of all that they have been given. When you think about Thrivent, we are the world's largest fraternal organization. A fraternal is a not-for-profit organization where all of the members share a common bond. Here at Thrivent, Our common bond is that our members are Christian. You may know that it used to be Thrivent Financial for Lutherans, but membership was actually opened up to all Christianity in 2014. A simpler way, maybe, to think of it is that Thrivent is like a financial cooperative where all of the members, in this case policyholders, are owners. We are not like a stock company. It's important that we are not beholden to the stockholder interest every 90 days, much more like a mutual in that regard. But unlike the mutual, for our not-for-profit tax-exempt fraternal status, we are required to give back to our communities. So that's just a little bit about Thrivent. Since we're fairly new, we've only been in the independent space for a few years. We launched in the midsummer, late fall 2019. People will ask us about, that common bond. It's a membership page on the application, right? And you have to attest to either being a Christian who seeks to live out his or her faith, or being the spouse of a Christian who seeks to live out his or her faith. That because we are a fraternal organization where our common bond is serving Christians, that is the one and only one Christian-related question on the application. Now, I would tell you, I'd probably verify that eligibility question long before you get to the point of taking an application, right? We just need to make sure it's not something you can bypass. Just like you have to qualify with your health, with Thrivent, you also the client has to attest to either being a Christian or the spouse of a Christian, because that's, as an organization, that's who we serve. So how do you verify it if you're not sure? You've maybe worked with these clients for years, and the statistics will tell you that 70% of the American population self-identify as being a Christian. So odds are your clients are probably going to be eligible to apply for Thrivent. But you don't want to guess. We created a positioning statement to make it very easy for folks to, as a rep, to identify if this is going to be a comfortable option to pursue or not. So we created our positioning statement. I have a few different solutions that we can discuss. One that I'd like to present is with a fraternal benefit organization called Thrivent. They're a top-rated financial services organization that was formed to serve Christians. I don't know if that's an option for you, and if it's not, that's okay. We have a few others that we can discuss. After you go through that positioning statement, you'll want to just stop talking. They'll let you know, hey, that's fine. Yep, I'm happy to take a look at that. Or, that's not for me. What else do you have? If they tell you that it's not for them, what else do you have? What do you mean I have to be a Christian? We understand that there's a lot of different denominations of Christianity. Some can be very different. Faith can be very personal. So if someone disagrees with the common bond, maybe they feel excluded or discriminatory, we definitely don't want to put you in a position of defense mode, right? Just pivot to another solution, because on the application they are going to be required to attest to either being a Christian, seeking to live out their faith, or being the spouse of a Christian who seeks to live out his or her faith. All right, so let's take a little closer look at who Thrivent is and the growth that we've had. I mentioned a few minutes ago that we entered the independent space in 2019-ish, the end of 2019-ish. 2020 was a jam-up year for us. I had exceeded our stretch goals by 37%. And then 2021 came along and we saw 451% growth from our independent distribution. Folks like you on the call helped drive those numbers, and there was a lot to it. So we did a rebrand in 2020, and besides targeting clients for a 9-month period, we also marketed to the distribution. We understand that in 2021, both MassMutual and Transamerica exited the long-term care planning space. Other solutions had updated their rates, making Thrivent even more competitive. Of course, Washington. We were in Washington for a period of time where other solutions were not. So we certainly saw business there. It would kind of force the issue for folks to take a look at it. And then, of course, the rest has been history. But we launched our Care Forward long-term care linked benefit hybrid solution in the independent space just a week ahead of schedule, which is always exciting. And we're not by any stretch of the imagination new to the long-term care arena. Long-term care planning actually dates back to 1987, when both Aid Association for Lutherans and Lutheran Brotherhood, as two separate fraternals, sold long-term care solutions from 1987 to 2001. Those two fraternals merged in 2001 to form Thrivent Financial. Now, we were busy putting together other products with Thrivent's name on it for a few years in there, but we so firmly believed that long-term care was important for our members and having our own solution. So we launched back into the long-term care arena in 2012. We are on our second generation solution today, which was launched in 2016. And then, of course, the Care Forward solution launched in this Q2. So pretty exciting stuff. We know that Aid Association for Lutherans was actually formed in 1902. Lutheran Brotherhood began in 1917. So we have roots that go back over 100 years. When you think about long-term care planning on the standalone side, the rate increase history is maybe recognized as the elephant in the room. Happy to tell you that there has been some increases on old Aid Association for Lutheran and Lutheran Brotherhood blocks of business. It happened once. It was in 2004. Pretty conservative. These rate increases are going to be a lot lesser than what you'd maybe see compared to business that was sold by stock-owned companies in that same exact time frame. To be crystal clear, there have been no increases on Thrivent branded products that have been available since 2012. So with our Care Forward solution, this is a true live, die, or quit proposition. Thrivent's very first life long-term care hybrid product to sit right alongside our traditional standalone solution to give you the very most robust set of long-term care solutions in this industry. How it works is it's permanent whole life insurance, providing tremendous flexibility for our clients. If they pass away, they still have that death benefit. If they change their mind, they can still surrender their solution. But really, what it's about is giving your client the ultimate flexibility on where they can receive their care and really trying to uh, get down to price points that you maybe couldn't have got to with other types of solutions. So real quickly, these are the main buckets that make up the structure on our solution. It is a reimbursement model. We go down to age 18 all the way up to age 75. We are in 48 states for this launch. We did not file in New York, and we are not approved yet in California. The other states are all approved, and again, this is a reimbursement model, whole life chassis, starting at age 18 up to age 75. As far as the face amount, the death benefit on this solution, it can be as low as $50,000 all the way up to $500,000. You can accelerate that face amount to get to your monthly long-term care benefit by either 3, 4, or 5%. There's certainly an outlier in this long-term care space. When you think about the ideal structure for a lot of folks, you think of the words short and fat. To get to short, you want to go with the 5%, or the fat, excuse me, the 5% acceleration on that death benefit is going to get you a robust long-term care benefit. And then as far as the pool goes, the total amount of benefit that's going to be available for long-term care, how you can figure that out a few different ways. But one of the ways that you can figure it out is you can just take this face amount times 1, 2, or 3 times. I'll show you a little bit more in just a second here. When you think about who it compares to, when we built this has been in the works for quite some time. When we built this solution, we maybe borrowed the best of each of the solutions. That's one of the advantages to coming in to the linked benefit space after we've have a little bit better idea of what's tried and true and what's working for clients and what's working for the distribution. So we built this to where you can get 3 times the leverage of the face amount for long-term care benefits, up to that 5% acceleration to figure out your monthly benefit. As far as those payment options go, we know that if these long-term care solutions were free, everyone would have them. And way back in the day when I started this industry 19 years ago, a lot of these came in on single pays, right? Now, we expect about 16-20% of our sales to come in on a single pay basis. But you can certainly do a 20 pay or 10 pay, 20 pay, or a pay to 95 as well, which is going to make this very, very attractive. We'll dive into the inflation guards in just a moment. But really, in a nutshell, these are going to be the main things that you want to think about. When you think about all these different moving parts, to get to like a straight up duration, you can go as short as a 20-month duration. To get to that 20-month duration, you're going to take a 5% acceleration on that face amount. You're going to multiply that face amount by 1, meaning only leveraging the death benefit, and you're going to get to a 20-month, like a 4% acceleration would be at 25 months. 3% acceleration would be starting out at 33 months. And then you could take that times 2 or 3 to get to your total pool. To get to the 100 months, it's just 3% acceleration, 3 times multiplier, technically gets you to a 100-month duration. This will make a little bit more sense when we dive right into the software in a couple of minutes here. As far as as a follow-up for today, we'll make sure that there's a 4-pager that compares our solution with some of the others. Biggest question we get on this that hasn't already been covered: what's the residual death benefit on this? The residual death benefit does not exist on a Care Forward solution. Want to be very, very clear that the very first thing to go on these solutions is the death benefit, just like all of the other solutions. Some of the other solutions do not have a residual death benefit. We do not. Some of them do, and I just want to be very, very transparent with you on that. The other question that we get is, how does the international how does the international coverage work? With our solution, it's considered an ancillary benefit. So in layman terms, your ancillary benefits are going to pay out at 2 times the monthly maximum benefit. Some might feel like that international benefit, just 2 times the monthly maximum, might be a little bit light. I bring that up so that you know, if your clients are thinking they want to receive care on a more permanent basis, this might fall short. If they're not as concerned about that, you should be sitting just fine. All right. And then I also wanted to just call out here real quickly, with our Care Forward solution, we have a 0-day elimination period for home health care. It's going to be a 90-day elim for all other types of services. But with our elimination period, those days for home care are going to count towards your elimination period to the tune of a 1 = 7. What that means in layman terms, if you receive care at least 1 day a week in your home, it's going to knock out 7 days of your elimination period. If you're familiar with that, you're probably nodding your head, oh yeah, that makes sense. If you're not familiar with that, I would follow up with one more comment. A 1 = 7 is going to knock out your one day a week receiving care is going to knock out 7 days of your elimination period. Or if you receive home health care 7 days a week, it's going to knock out 7 days of your elimination period. Hopefully that gives you a little bit better idea of how this, what this means. All right, I'm going to zip to just a couple of output pages before I do some hands-on work in the software. We have a projection here on a hypothetical claim. So in this case, it's going to be a 52-year-old client that had bought a $4,000 monthly benefit. In this case, at age 80, this client goes on claim. She had a pay to 95 as far as her payment mode goes. And when she triggers her Care Forward solution at age 80, you can see that the premiums are waived. They're 0 here. So she started out with a total premium of $37.25 through age 95. But when she goes on claim, her premiums go to 0. You can see what the long-term care benefit is paying out each year, and then how it's going to pay out over a 4-year period. In this case, the death benefit is burned fairly quickly, right? So you burn through that death benefit first, and then it's showing you've got what you've got for long-term care benefits, what that monthly benefit is at. In this case, it looks like we did not have an inflation option on there for this 52-year-old. My point is, though, besides the death benefit being the first to go, in this hypothetical claim, after 4 years, this client gets better. So, because there's a breakdown in the quote for both the long-term care charge and the life insurance charge, you're only paying for the long-term care charge once you recover and become claim-free. In this case, the total premium with the death benefit and all was $37.25 prior to that long-term care claim, and then the premium is waived. She gets healthy. She goes back, starts paying in her premiums through age 95, and it's only the amount of the long-term care charge for that period of time. Clear as mud, hopefully. Wanted to make sure you understood that. The other thing that I wanted to cover with you is let's take a look at how the underwriting works. Number one, our Care Forward solution is underwritten here at Thrivent. Our traditional long-term care solution we've partnered with LTCG on, but life insurance is a very, very big part of who Thrivent is. Not in like third-party distribution, but it's a big portion. So we have an underwriting team. So we have it underwritten by our own folks here at Thrivent. There's a pre-qual form that you can leverage. It's gonna make things a lot easier as far as understanding which of the 4 rate classes this client is going to be eligible for. There's a non-tobacco and a tobacco rate, and then for higher risks, there's a non-tobacco class 1 and a tobacco class 1. So we get the question a lot: isn't the underwriting easier when it comes to the linked benefit solutions? What I would tell you is that underwriting has evolved over the years with linked benefit solutions. You can look at our underwriting guide. It's got both the Care Forward and the traditional solutions in that underwriting guide. What I would tell you, though, is that the process for the client and the underwriting guidelines for the client are going to vary between our traditional standalone solution and Care Forward. In fact, when you think about the DOI, Declaration of Insurability, it's 2 very separate processes, 2 separate guidelines. It's not going to be a good experience for your client to apply for both Care Forward and the traditional solution at the same time. And if the client has already been declined with Thrivent's traditional solution or rated up to a class 2 with our traditional solution, they're probably not going to be a candidate for Care Forward. I mean, if there is a situation where the health has improved, the reason for that rating no longer exists, you can certainly pre-qualify it to verify the eligibility, the correct rate class. You can certainly do that. But generally speaking, if they were rated up or declined on the traditional side, they're probably not going to be eligible for the Care Forward side. If you have a really tricky case, just do your best to give us as much information as possible, so that we can give you a quality answer back. You want to know that we do offer an accelerated underwriting for ages 60 and under. But you do want to be aware that if something comes back, whether it's in the prescription drug database or the MIB or even in the Declaration of Insurability, it can toss them into full underwriting. And again, if they apply for both Care Forward and the traditional solution at the same time, it's automatically going to kick them into full underwriting. In addition to that, Thrivent will randomly select 10% of our cases to go through full underwriting, just to make sure that we're okay with the process for accelerated underwriting for this large of a age span. So we do have a comparison tool that is really, really a nice tool to be able to leverage. There's a lot of different ways that you can use our comparison tool. You can put 3 standalone solutions side by side. You can put 3 care forward solutions side by side with way different packaging, or maybe you want to show a single pay, 10 pay, and a pay to 95. It's the sky is the limit here. What I would tell you is that there are plenty of different ways to package this. In this hypothetical, we did a standalone with a $4,500 a month 5-year on a 55-year-old female with a 3% compound inflation guard. The rates are coming in at $46.20. You can see what the benefits are going to be at age 80 on a monthly basis, the total pool of money. We even have a self-funding comparison tool. In this, you can put in your own customized assumed rate of return. You can actually even identify what tax bracket the client is going to be in that's wanting to self-fund. And it really does a nice job of explaining how much you'd have to set aside. So pretty cool tool that a lot have really, really fallen in love with. But here's my point. If you're doing a care forward solution with like-for-like benefits, same $4,500 a month, to get to this 5-year duration, we just took a 5% acceleration on that death benefit, 3 times multiplier, kind of our sweet spot to get to that 5-year benefit period. At age 80, obviously the benefits are going to be the same as they were on the traditional side. The difference is that you have a $90,000 death benefit, and then of course you can cash this out as well. This cash out amount is going to change each year, which is on the output of the quote. So what's the difference in the price? It'd be about $1,000 a year difference to go from a traditional standalone with this packaging structure to go to a care forward. But we have one of our options on this solution is the 3% compound with a 20-year cap. Now, in a 3% compound with a 20-year cap, the benefits at age 80 are going to be reduced, right? 81.29 versus 94.22. Your pool of money is going to stop growing too after 20 years. But I guess for less than a tank of gas, 46.20 versus 46.66, you're going to have 8,100 in long-term care benefits at age 80. I don't think anybody's going to be throwing rocks at you if you're able to put a solution like this together, and for less than a tank of gas, they can go into this care forward solution if they're comfortable with this level of benefit. I would say that when it's $1,000 a year difference in premium, it could possibly be the difference between yes and no. So I'm going to take just a couple of seconds and jump into the software, just to hopefully help you wrap your brain around how to get into what you're going to do to run the software and that whole packaging concept. I'm guessing this is probably timed out on me, but I could be wrong. Let's see what it does here quick. And to access this, you're going to that partner.thrivent.com site if you run your own quotes, and you're clicking on quotes and printable applications. When I click on run a quote, I'm going to hit the drop-down box and either click on that comparison tool that I just showed you, or I'm going to click on Care Forward. In this case, I'm just going to choose Care Forward and hit Create. Now, once I have hit Create on this, it's going to allow me to type in my client's first and last name. Remember that we can save age for up to 30 days after the client's birthday. The only thing I'll call out on that is that the application does need to be within, in our hand, within that 30-day window for saving age. If you're not going to save age, you can just wipe out the date of birth and just put in the current age, without saving age. You choose your gender, choose your state, and then here's your risk classes. With our Care Forward solution, if the client is part of a couple, regardless of who applies, they are automatically going to get a full couples discount. That's a really, really nice benefit. And then there's a lot of different ways that you can fund this. Your single pay, 10 pay, 20 pay, or pay to 95. I'm going to pick on the 10 pay for just a second. If, for example, you want to roll some money into the to the 10, like with a 1035, you would just indicate what the cash surrender value is going to be on this solution, and then of course you can build this on a monthly maximum benefit of $5,000 today, or at age 80. What it's telling me here is that I need more robust benefits based on the $50,000 dump in. I'd either have to put an inflation guard on there to keep this happy, or because without inflation, with my $50,000 dump in, it was telling me that I needed a higher benefit, higher than a $5,000 monthly benefit on a 10 pay. I'm just going to take my $50,000 dump in off of here, just to keep it simple. But I did want to show you that error message just in case you happen to get it. You understand what it's trying to get to. So if I have this client's 53 years old and we want to solve for a $5,000 monthly benefit at age 53, we can do so. We can change our monthly multiplier to 2 times the face amount if we want, and as you can see, we've got a 40-month plan. It's automatically going to calculate that for you. You can see what your pool of money is going to be, what your death benefit is going to be. In this case, it starts out at $100,000 for your life insurance side, and then your $200,000 for your pool. If we take that to 3 times the multiplier, the death benefit stays the same, but your long-term care pool starts out at $300,000, and then you've just got the $5,000 monthly benefit for your monthly maximum. What I want to show you, though, to hopefully help with the packaging. Now, I did this on a 10 pay, and I'm going to throw inflation on here just because of the age of the client. I think that'd be a good best practice, right? So in this case, let's say you put in $13,000 for 10 years, and you have a 3% compound on here. Your total long-term care benefit starting out is going to be $300,000. At age 80, it's going to be $666,000. Your monthly long-term care benefit goes from $5,000 to $11,000. Maybe and the cost on this is $13,000. Maybe your client wants a little bit more death benefit, just to kind of go along the lines of the money in, money out thing, like on these shorter pays. You may have to go down to like a 4% acceleration and a 2 times multiplier. See what I'm doing on with my premiums here. If I go to 3 times multiplier, it's $15,000. If I go to 2 times, whoopsie, it's going to be about 14,000. Maybe what I'm going to be better off doing is going to a 20-year cap on this thing. Now I've got a face amount of 125,000, so it's pretty much money in, money out, right? For the face amount versus the premium. And then I've still got a long-term care benefit starting out at 250,000. It's paying out over a 50-month period. At age 80, I've got 451,000 in long-term care benefits. Hopefully I haven't completely paralyzed you all. That kind of makes sense. There's a lot of different ways that you can build this thing. For example, you could say, show me a $8,000 monthly benefit at age 80, right? And it's going to do the exact same thing. And then you can kind of just back into the numbers here. So here you've got a $10,000 premium. What's that $10,000 going to buy you? Roughly $110,000 in life insurance, $220,000 in long-term care starting out, roughly $400,000 in long-term care benefits at age 80 with that $8,000 monthly benefit. And again, you can just, you could take this to a 5% acceleration and, drop the premium a little bit. Maybe you want to show a 20 pay or a pay to 95. Now we're talking. You could also do something based on a premium. You could do it on a total pool of money. You could also do it on a premium. So on a pay to 95, what if that person said to you, I've got $4,000 to spend on a annualized basis. Can I get there? If I wanted 5% compound inflation, and I was looking at this structure, it's telling me you can't get there with a 5% acceleration on this. So, and if I go to a 3 times multiplier, it's going to be, you have to put in 5,100. So what if we took this down to a 3% inflation guard? Now it's happy with me again. I look at my monthly benefit today. I look at my monthly benefit at age 80, and I say, that's not bad. What else can we do? So for $4,000, you can package it just the way it is and have a monthly benefit of $75.47. Or you could go with a 2 times multiplier and have an $8,600 monthly benefit. Or you could take maybe they're concerned about going on claim tomorrow. You could take this to a 3% compound with a 20-year cap. It's going to instead be $4,700 starting out for that same $4,000 per year and a monthly benefit at age 80 of $8,610. So really the sky is the limit when it comes to these different packages. I'm really only scratching the surface as I'm showing you these, different components. But for coming from the mouth of a true long-term care nerd, this is really a fun, very exciting way to put this type of solution together. So I want to take just a second and just show you these output pages. Before I flip to that, I want to call out that you can technically look at a cost of care by state if you're needing a little bit better track to run on. And then I'm going to go in and show you some of these optional pages that you can technically click on here. Come on. There we go. So I could do the what care costs right in the output itself. I could do a break even. We already did this hypothetical on the claims, so I'm not going to take the time today to show you that. What I am going to show you is the plan option comparison page. And then, for those that have longevity, you can change these values from 80, the default, to whatever you want to put in here. Once you've got everything in that you want to put in, you can click on the Save Submit button, and it's going to populate your quote. When you go to make an application, remember that you'll need to attach a copy of your a copy of your quote to your application. All right, lastly, I want to make sure that you see the output. Of course, we're pretty excited about that A++ rating and who we are as a company. That really is our foundation. We talk about what this policy brings to the table, right? It's a comprehensive solution. It's going to cover all these things, but not limited to these things. It talks about what that premium is going to be, what the death benefit is, and then what the long-term care benefit is starting out. We break out for you the charges for the life insurance annualized premium versus the long-term care annualized premium. And I think I did this one on pay to 95. If I remember, I'll look here in a second. But it's going to show you how much you would have paid in over X period of time. Here we've got our leverage. So it starts out at $200,000 for long-term care benefits at age 85. It's going to be $517,000. Your monthly benefit goes from $3,300 to $8,600. The death benefit, of course, is the first thing to go. You trigger these benefits at age 85. The death benefit is going to be the first thing to go. You're going to have all this extra long-term care benefit to continue using once that death benefit is gone. If, for example, you'll go on claim for a short period of time, you start out with that $67,000 death benefit. You pass away, the balance of that death benefit is going to be paid to a beneficiary. Okay, so that's where the die section goes in. If you don't use all your death benefit, which happens to be the first thing to go, a beneficiary is going to get that death benefit back. We illustrate that on a few different pages. Here, though, this is what I would call the meat and potatoes of this solution. It's going to show you your annualized premium, the sum of what you've put into the policy, the cash surrender value. And by the way, there's actually 2 pages. This goes out through age 121. I'm not going to go out that far today. You can see what your death benefit is. This is a whole life solution, so you can see how the death benefit works. The long-term care benefit, something I want to call out. If you're using the death benefit as part of the long-term care benefit, you'll notice that the inflation is going to grow on that monthly benefit at day 1. So at age 85, when your client goes on claim, you can see your monthly benefit is going to pay out at $86.33 if you trigger a home health care claim on day 1, $517,000. All right. Other things that I wanted to make you aware of. Here's our break even. Pretty simple to explain. You can go on claim for a very short period of time and get your money back. But of course, there's still going to be that death benefit component too. If you want to, let's just say, like in this case, you're showing a 5-3, 3 times multiplier, 5% acceleration, and your client instead wants to see a different package. You can show them what the benefits are going to be today, what their benefits are going to be at age 85. If they go to a 4 times 4% acceleration or a 3% acceleration with these different inflation guards in here. So you don't have to run a million quotes to get to some different price points. Here we've got the cost of care that I chose to include in the output, which is kind of exciting. We talk about the built-in benefits in case the client is not overly familiar with this type of concept. and then just some key terms to understand. Truly, we tried to make this a great tool, for you to have a great handle on as you're going through things. With that, I guess I could do packaging like this all day long and twice on Sundays, but I wanted to just give you enough to kind of wet your palate, I guess, a little. I would leave you with, when you think about Thrivent as an option, know that we are here to help your clients. It's for the greater good. We're here to empower. We're here to inspire. We're here to give you leverage and synergize. Hopefully you feel between our traditional solution and this Care Forward solution that you can get to more demographics with the true flexibility, not only in the packaging, but also in the payment options to really make a difference for your clients. Get them some meaningful benefits with that 5% acceleration on that death benefit if they're looking for meaningful benefits. That's the story of Care Forward. That's the story of Thrivent. I know I crammed a lot into a fairly short period of time, but I do want to thank you for being on today's call. As a follow-up from the Golden Care office, you'll receive a couple of great tools to hopefully give you even a better handle on some of the support materials. If you do have any questions, don't hesitate to reach out to the Golden Care sales desk, and they'll be more than happy to assist you when it comes to long-term care planning and, of course, what Thrivent has to offer for long-term care solutions.
Thank you, Melanie. That was great. I know we have some questions here. I don't know how you're doing for time. I thought maybe we would
I'm
just
good.
switch out to these. You are good. All right. Well, let me
I'm
throw
good.
a few. Let me throw a few at you here.
Yeah.
Let's see. Is there a customer support, care support, phone number, or website, some sort of lifeline there for agents?
Yes. So for the reps themselves, you'll actually work with the Golden Care sales desk to put together your packages. Of course, Thrivent does offer, support, but that's one of the biggest perks to being partnered with Golden Care, letting them take a microscope in, at these solutions and help you with the packaging to really feel good about how these both of our solutions work.
Agreed. Yeah. You can always, as agents, you can always call into the carriers, and if you want to be autonomous, that's perfectly fine, but that's what we're
Sure.
here for, is to assist. So if you need
Hmm.
quotes, you need some product overviews or materials, applications, excuse me, we're always happy to help. Me, John, Jeff, Lynn, Manny, anybody on our team, our marketing team here at Golden Care, always happy to help. So thank you for that, Melanie. Let's see. One of our agents wanted you to go over the LTC payout percentage and kind of how that works. You mind doing that?
Yeah.
Okay.
Yeah, absolutely. So, that payout percentage, actually, I should probably just pull up that software again here quick. With
And
that
let me interrupt you
payout
quick.
percentage.
I don't mean to,
Yeah,
I
yeah.
don't mean to be rude. One of the questions that somebody else asked as well is, how do we access this tool? And I remember that you mentioned it. I typed it in a web browser right away. So we said
Awesome.
it's, apparently I lost the
Partner.
actual.
Here we go. It's partner.thrivent.com.
Okay, got it.
And when you go to that, you'll need it'll ask you for your username. Actually, I'm glad
Okay.
this is coming up. This is good. There's actually two different ways that you can access it. You can go through Winflex. right? And if you're already on WinFlex, great. If you want to be on WinFlex, you can. That's perfectly fine. If you don't want to be on WinFlex and you have a writing number, you can go to this partner.thrivent.com site and you punch in your writing number. Hopefully you remember your password. If you've been with us a while, on the traditional side of the house, you're using software more than likely through IGO's platform, and CareForward is not on IGO as far as the quoting software goes. EAP obviously is, but the quoting software, you have to go to either this partner.thrivent site or you have to go to WinFlex. So if you have a writing number, you're welcome to go into partner.thrivent.com and punch in your writing number and then and your password. If you don't know it, you'll see this 800 number here listed on that login screen, so you can get your password reset. You just need to give them your writing number so they know that who you're with. If you have troubles on that, remember that Thrivent's been a career shop for forever. The only thing that we offer in third party is long-term care solutions. So it gets slightly clunky. They're going to ask you for your employee ID, which is your writing number, right? So yeah, I'm glad you brought that up.
Yeah, absolutely.
Yeah. So, and yeah, as far as that percentage payout goes, the percentage payout, if you're building it on a premium or a face amount, for example, your percentage payout is going to dictate your monthly benefit of, like in this case, a 5% payout on $100,000 is going to start out at $5,000 per month. If you go to a 4% payout, it's going to be $4,000 per month. 3% payout is going to be $3,000 per month. If you're building it just on the monthly benefit of $5,000 in today's, at today's age, this percentage payout, then because your main thing is I need a $5,000 benefit today, and then you can choose the inflation. What this is going to do, watch the face amount when I go from 5% or from 3% to 4%, and watch the premium. So here I've got a face amount of $166,000 and my cost is $87.81. Now I'm going to change that to 4%. And it drops the premium to $7,082. Why? Because what makes these linked benefit solutions expensive? What makes them expensive is the life insurance portion, right? So if you can water down your life insurance benefit and get yourself to a good, meaningful long-term care benefit, this thing is going to pay out over 75 months. That's still kind of a long skinny. Now we take it to a 5% acceleration. Now we're down to just under $6,000 per month, and we're at a 5-year period. Now we're starting to talk, right? You could go to even a 5-year might be a little long for some of your clients. Maybe you want to go to just over 4 years. You could go to a 40-month. 36 months is 3 years. Just over go to a 4-year. There's a lot of different ways that you can do that, but hopefully by playing around with this percentage payout, you can kind of see how it's going to affect your duration, right? When you go to this this lower percentage, it's going to make it longer and skinnier, right? We're trying to go for short and fat. So I'm gonna take it to a 5% acceleration on that death benefit, which is going to give me the most bang for my buck here. Does that help?
He's not going to be able to answer, but we'll like to say sure. That was great. No,
Okay.
that made
Good.
sense to me. Thank
Good.
you. What else do
Yep.
we have? Refresh my memory. What does DOI mean?
So DOI stands for declaration of insurability. And what that means in layman terms is that's going to be the health questions outside of like your knockout questions. So the declaration of insurability could be everything from height and weight, medical history like medications, past surgeries. If you've been diagnosed with something, had surgeries on something, that's going to be your declaration of insurability. And with Care Forward, the client completes their own declaration of insurability. It can be done either via phone interview, or there's actually an online link that they can click on to complete their own declaration of insurability.
Okay, great. All right, and I think that about wraps it up. So thank you, Melanie. That was fantastic. I know I learned a lot. I hope you all did too. Thrivent Financial is a great company, and they're a trusted partner of Golden Care. If your clients are looking to stay at home and protect their assets, Thrivent's Care Forward is a great option, as we all just learned. And if you're not already appointed with Thrivent, in order to get access to that really nice quoting software, you got to get appointed to get that writing number. So take that next step and call us here at Golden Care at 1-800-842-7799. Or you can go to our website at goldencareagent.com, and we would be more than happy to help. So thank you again, everybody, for your time. Thank you, Melanie. I appreciate it, and I hope that you all have a great rest of your week. Goodbye for now.
Thanks. Bye-bye now.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799. Check out our website, goldencareagent.com, or give us a call at 800-842-7799.